Good morning, afternoon and evening, everyone. Welcome to March's edition of the Esgian Rig webinar series. In today's presentation, we'll be reviewing Q1's activity and sharing Esgian's forecast for the remainder of 2024. Today's presenters are Matthew Donovan, head of our rig market research based here in Houston, and Sofia Forestieri, senior rig analyst based in our Oslo office. Before we start the presentation, just a couple of housekeeping notes. The presentation will last approximately 30 minutes and will include some time for Q&A. To ask a question, please use the question and answer icon at the top panel of the Teams window. Today's presentation is being recorded and will be posted onto the Esgian website later this week. I would now like to invite Matthew and Sofia to start the presentation. Matthew, over to you.
Thank you very much, Paul. Appreciate it. And thank you everyone for joining us here today for our March presentation, Navigating 2024, a global Q1 review and year ahead forecast. Joining me today is our senior rig analyst, Sofia Forestieri. Next slide, please. Just the disclaimer at the beginning, as per usual. And we're going to start today by looking at Jackup trends in the first quarter of the year. So turning now, the global Jackup fleet stands at 499 units. 75% of those are actively drilling at the moment, with others that are warm stacked or undergoing repair or SPS. Many of those already have contracts lined up. So while our current demand is around 75%, it's actually higher when you bring in the units that are not currently working. If you turn it to the supply or regional breakdown, you can see activity for jackups remains clustered primarily in the Middle East, with strong demand also from the Far East, the Indian Ocean, and Southeast Asia, Mexico, and the North Sea. There are still a number of cold stacked units, around 62 at this time. While some of these have been reactivated over the past several years, many of the units remaining are not available. Many of these cold stack units are not available for future work, and some may not return to the market going forward. Next slide, please. Turning now to jackup demand and utilization. So over the past 2 years and continuing into the first quarter of this year, we saw increased demand in the Middle East, which drew a large number of jackups to the region and boosted utilization globally, absorbing much of the spare capacity from around the globe. That total utilization, as we saw on the previous slide, has trended up towards 75%, while competitive contractor utilization, which includes rigs that have future contracts, has remained at 90% or above since early 2023. So we're remaining quite high utilization going into the first quarter of 2024. Middle East, as I said, accounts for the majority of jackup demands, particular activity in Saudi Arabia and the United Arab Emirates with state oil and gas companies. Southeast Asia and the Far East are also major markets for jackup activity, particularly in China, though most of this activity is limited to Chinese-owned rigs and state-owned Chinese companies. However, one change we have seen in the first quarter of 2024, while demand has not lessened yet, recent announcements by Saudi Aramco point towards some possible changes in jackup demand going forward. In the first quarter, it's been quiet for the jackup market when you compare to recent quarters in terms of new fixtures and backlog added. And that's partially a result of the large number of fixtures that we saw over 2023. What we see in the first quarter of 2024, rather than a large number of new contracts, is the operators that signed up rigs over the past several quarters moving into a mode where they are dealing with putting these rigs to work and assigning them jobs throughout their fleet. We are still have a number of tenders open in regions around the world, so we should see some new multi-year fixtures before the end of this year. Turning now to the news with Saudi Aramco, we are expecting Saudi Aramco to possibly release some jackups over the coming year. In January, Saudi Aramco received a directive from the Ministry of Energy to maintain its maximum sustained capacity for crude oil production at 12 million barrels per day, reversing the previous increase to 13 that was announced in March 2020. This has led to widespread speculation and assumptions that Saudi Aramco will be modifying the number of jackups it has under construction, under contract. Aramco is currently operating around 85 jackups under contract, with an additional seven slated to commence work offshore Saudi Arabia within the coming months. 6 of those currently undergoing maintenance before they begin their contracts, while 1 is expected for delivery before the end of the year. The Saudi Aramco CEO has announced plans to reduce the offshore rigs used for oil projects while increasing the number of rigs for gas projects. Aramco has said that it is aiming to maintain around 300 rigs. That includes both onshore and offshore units, with a shift towards natural gas projects. It's currently unclear how many jackups Aramco will suspend, cut from its fleet, or not renew due to the reversal of these production goals. So what we're seeing in Saudi Arabia right now is there are around 23 contracts that are set to expire between now and the end of 2025, which could highlight a potential shift in market dynamics and contracting strategies for this state oil company. And we understood that Aramco has already sent letters requesting the suspension of several jackups, reflecting potential adjustments in response to this. And we understand they are aiming to finalize these negotiations over the next month for the jackups. Now, market participants have speculated that anywhere between 10 to 30 units could be released. It does not mean that Saudi Aramco may not contract new rigs in the future. As the CEO has said, there will be a shift towards rigs that are being used for gas projects rather than oil projects. So there may be a shift in the makeup of the jackups under contract with Saudi Aramco. But we are expecting some of the units currently with the company to be released in the coming year. Turning now to the North Sea this quarter, there is a limited supply of jackups in the North Sea, most of which are currently working. Following a period of slow activity in terms of new rig awards, North Sea jackups in the first half of 2023 saw contract activity accelerating in the fourth quarter and early 2024. Around 6 years of backlog added for jackups in the first quarter of the year, compared to 14 years added in 2023 as a whole. And what we've also seen over early 2024 and late 2023, several jackups, in response to the slow market in the North Sea, secured contracts in other regions. In conjunction with the recent increase in contracted activity, this has resulted in a much tighter market in the North Sea with little remaining availability. And the costs of reactivation and repair will limit opportunities for some of the cold and warm stacked jackups in the region. We're already seeing contractors looking at opportunities with 2025 start dates and beyond. Now, the Energy Profits Levy in the UK resulted in some work in the region being postponed, and that EPL has recently been extended into 2029. We believe demand could again potentially be negatively impacted by these changes to the levy and the results of the upcoming elections, but we should still see some increase in activity in the North Sea as a whole as we move into 24 and into 2025. Some projects, including P&A work, will continue despite the EPL. Now, looking ahead further to the jackup market in 2024, our jackup demand forecast remains largely flat in the near term. There is likely to be increased availability in the coming years as Saudi Aramco adjusts its jackup demand, but we do expect overall demand and utilization for the market to remain high. Drilling contractors are expecting demand in other regions of the Middle East, the Indian Ocean, Southeast Asia, and West Africa to absorb much of the excess supply from any additional units that are released from Saudi Aramco. What we've seen, as I mentioned in recent quarters, is very tight market in non-Middle Eastern areas as the excess capacity had largely moved to the Middle East. So with any of these units released, they're likely to filter back into other regions, increasing the availability there temporarily, but being absorbed eventually by the expected increase in demand. And right now, there are long-term tenders and pre-tenders open for work in countries including Qatar, Malaysia, Nigeria, and Angola. And we've already seen, in anticipation of Saudi Aramco cutting units, some drilling contractors have already begun offering these units on charters outside the region, even though they may remain under contract to Saudi Aramco at this time. So anticipating that they may not have their contracts renewed. So I think what we're seeing going forward is flatter for the market, but because that excess demand from other regions will absorb the excess supply that leaves the Middle East. Looking at day rates, the uncertainty in the market is expected to keep jackup day rates flat in the near term. Jackup rates in the first quarter of 2024 largely been commensurate with what we'd seen in the previous quarter of 2023, although there have been some upticks on the higher end of the market for premium rigs. We are expecting some jackup rates to increase over the next couple of years as that uncertainty decreases and rigs are signed to long-term contracts, decreasing the amount of available units globally. Oops. And now we're going to move on to the floating rig market, and I'll be passing it on to Sofia.
Thank you, Matthew. So yes, now we are going to talk a little bit about what we saw this quarter in terms of floaters, and also what we're expecting for this year and in the short term as well. So a quick overview. So what we have today in supply, both drill ships and semi-submersibles, is at 208 rigs. And when we break down the supply into regions, we have top 4 regions that are driving this number. And those regions are South America, US Gulf of Mexico, and West Africa, forming what we know as the Golden Triangle. And we also have the North Sea. When it comes to South America, Brazil is the leader, both in terms of supply, but also rigs that are currently drilling. And it's followed by Guyana, where we're seeing a lot of exploration activity. Norway drives the numbers behind the North Sea. And in West Africa, we see Angola and Namibia driving the supply and the drilling activity in the region. Now, when we look here at the select fixtures, the number of fixtures, as we're going to see in the next slide, has not been the highest this quarter, but there have been a few fixtures that are worth highlighting, both in terms of duration, but also high day rates. So we see here drill ship, all of them are for drill ships, and with day rates above $435,000, we $190,000, and they're all in South America or US Gulf of Mexico. And in South America, again, we see Brazil as the one with the highest number of fixtures, but we also see Suriname with Petronas. Now, in terms of demand and utilization, we have seen floater demand improve a lot since the COVID-19 pandemic. So today we have utilization around 70%, and that has been the trend the last 3 quarters, so the last half of last year and this quarter, and this is up from 33% since the pandemic. South America is one of the regions experiencing a boost in terms of drillship demand, and that's mostly due to the Petrobras contracts. But we also see that in Guyana and Suriname because of the exploration activity, and we also see that happening in Colombia with frontier offshore exploration. US Gulf of Mexico has seen a rise in 2023, but we do expect demand to stay relatively flat in the short term. West Africa has a similar trend to South America, and that is propelled by exploration in Namibia, as well as long-term contracts in Nigeria and Angola. One very interesting trend that we also see for floaters is that the contracts, they are lengthening across the globe, and that is due to operators wanting to secure rigs for their future projects, as well as hedge against a potential uprise in day rates. Now, when it comes to fixtures, as I mentioned, we've seen fewer fixtures this quarter, but again, with the with this trend for long-term contracts, we have had a backlog of around 28 years, which is very similar to the backlog of the past 2 quarters. Some of the fixtures that are worth mentioning this quarter are the just awarded semi-moored rig tender for Petrobras to Castle's Nanhai 8 rig, as well as we have Valaris ZS4 again with Petrobras, also in Brazil. Now, when it comes to day rates, again, even though we have had fewer fixtures, the average day rate for the quarter was around $373,000. Mainly driven by the fixtures with high day rates in the U.S. Gulf of Mexico and South America. And even though we had less fixtures, the average day rate was 7% higher when compared to the last 2 quarters. And here on the right, when we look at the backlog added, we start to see a preference for drill ships compared to semi-submersibles. Now, when we focus on South America, first of all, globally, we do expect 2025 to be a very busy year, and that is reflected in South America, where we have a very high number of rig requirements. Now, when it comes to demand, South America is responsible for around 26% of the global demand in rig years. And in South America, when it comes to backlog added in this first quarter, South America is responsible for 32% of the global number, and just Brazil responsible for 28% of that number. So we do see Brazil as continue to drive the global floater demand. And we also see contributions from Suriname and Guyana, where the discoveries are moving into development projects. And one very interesting thing about Brazil is that even though the clean day rates, they tend to be a little bit lower than the global average, we do see long contracts, especially from Petrobras, but we also have seen a preference from operators for rigs with MPD and dual activity capability. So before, in 2014, we had very small number of rigs with both MPD and dual activity, and now in 2024, the Brazilian fleet, 54% has MPD and 64% has dual activity capability. Now, when it comes to the North Sea, demand, so there has been a soft demand in the North Sea, and the high demand that we see elsewhere has driven the harsh environment semis out of the region, which means the supply has shrunk over the last couple of years, and today we have around 28 rigs in the region. We do have one exception to that, which was the recent arrival of the Castle Prospector from China for a 2-year contract in Norway, starting later this year. Now, when we look at semis, the trend for semi fixtures, we see that there has been a recovery since the 2020 downturn with the pandemic. And we do see that the average duration of contracts has increased, and it spiked in August 2022, and then it goes over the 2020 levels towards mid 2023. One interesting fact is that in 2023, Norway topped the day rate records in the North Sea and beyond, and that was with a contract with Odfjell Drilling's Deep Sea Nordkapp, which secured a day rate of $490,000 for 2026, and that even surpassed, as we saw in the previous slides, rates in Africa and even in South America. Demand is flat, but we do expect some increase this year and through 2025. Now, when we come to Australia, has seen its supply increase to 6 semis in the recent months, and that is due to 2 units that were moved from the North Sea to Australia. So we have Transocean Equinox en route to Australia from Singapore for multiple contracts, and we expect the rig to be busy until 2028 if all of the options are exercised. And we do have Transocean Endurance, which arrived in late January for a contract with Woodside, and it has its contract until 2026. When it comes to fixtures, we do not see in the past couple of years Australia being busy in terms of awarded contracts, but we do see something that is very interesting is the duration of the contracts. So once a rig arrives in Australia, it has the tendency of stay there for a very long time. And that is also supported by day rates that tend to be around the global average for both semis and for semis in the region. One other thing, when we look at rig requirements, we do expect the region to be busy in the next few years, and that could cause a strain in supply, given the activity that we have today, and that all the 6 rigs are currently booked for some time. We have some recent interesting news as well in Australia. Santos has been able to restart work on drilling and pipeline work at the Barossa gas project offshore the Northern Territory following legal challenges that were happening. And we also have the recent news that New South Wales has passed a legislation to ban offshore drilling. So that casts some questions on the PEP11 project that was in the pipeline. Now, looking into the future, when we look at global utilization forecasts for semis and drill ships, we expect an increase in demand around the second half of 2026 of around 30%. Again, Brazil is to be mentioned as one of the drivers of the South American increase in demand in the future, as well as activity in West Africa. We do expect, as we can see from the chart, drill ships to remain as the preferred rig type for activity in benign deepwater environments. But as the drill ship market remains tight, some work will move into semis, and that's where we see this increase in semis towards late 25, early 26. Drill ship supply over the next few years is also will be limited to existing units, delivery of the current new builds, and reactivation of cold stacked units. So we do not expect new orders of drill ships, and that is mostly associated to costs and the long lead times of new build projects. And in terms of outlook, when it comes to the day rates for both semis and drill ships, we do expect growth. We do expect the growth in demand and the limited supply, which drives, of course, the high utilization to also support elevated day rates. But we do not expect a high uptick in the short term for neither semis or drill ships. So we do see an annual growth level between 2 and 4%. And this uptick that we see here on the right for the drill ships, it's mostly due to those recent fixtures that we went over, around $490,000. So they are driving this uptick, but we do expect the range for drill ships to be in between 6th gen to be in between around 400,000, and for 7th gen drill ships between 400 and getting close or approaching the low $500,000. And when it comes to semis in general, we do expect it between $300,000 and $400,000 day rates. And now I move to the key takeaways. Matt, do you want to take this part?
Yes, thank you, Sofia. So key takeaways from this. Despite some availability in 2024, the jackup and floating rig demand is expected to remain strong over this year and into 2025 and 2026. As Sofia mentioned, day rates for rigs are likely to be flat in the near term due to some availability in the floating rig market and uncertainty in the jackup market at this time. But long-term contracts are expected to tighten floating rig availability in 2025 and 2026, which should prompt some upward movement in day rates. Middle East will remain the primary market for jackups, but contractors are expecting demand in West Africa, India, and Southeast Asia to draw further units. Thank you for joining us today, everybody. We're now moving to the Q&A session of our presentation.
Thanks, Matthew and Sofia. Some interesting numbers and conversation there. Really appreciate it. We do have just a couple of questions that have come in. One around sort of new builds. What kind of market conditions do we see would be needed for a drilling contractor to order a new drill ship?
That's an interesting question, and I mean we've really not seen any significant new floating rig orders in recent years. And what we've heard from several of the major drilling contractors is that the market as it is currently wouldn't support new orders at this time. So based on their expectations, new drill ship would take minimum of 5 years from order date to delivery, and that could really be anything closer to 5 to 8 years. And costs on those, several of the major drilling contractors have said that a new unit would cost close to $1 billion. So they would need initial contracts for the units to run for over 15 years at a day rate in the high 600,000s or above. So not currently supported by current market conditions, I think, even though the drill ship market is very tight.
Switching over to jackups, we had a couple of comments and questions. You'd mentioned about the situation in Saudi Arabia. So with jackups being released in Saudi Arabia, how do we see the effects in supply in other regions?
Well, Paul, as I said, it's still unclear how many rigs will actually be released. That's sort of still in process. Market participants have mentioned anything from 10 to 30 units, possibly over a certain time frame. And I think it would be important that many of those wouldn't be cut all at once, probably more a gradual thing. So there hasn't been a change in the global supply movement yet, but I think what we would see is rigs cut from Saudi Arabia. First, they're going to be bidding on contracts in other parts of the Middle East, so Qatar, UAE, and then we would probably see some move to, I think, India, Southeast Asia, and possibly West Africa as well. So definitely a potential for increased supply in those regions. But it'll basically be in response to increased demand in those regions, rigs that places where they haven't been able to secure a rig beforehand for upcoming work may be able to get something when available supply increases.
Okay. Another one on sort of supply of drill ships. Total's 75% stake in the Vantage drill ship.
Yeah.
Do you see others taking similar investments with more operators investing in rigs?
Very interesting movement there from Total. Yeah, 75% stake in the Tungsten Explorer. I think probably it's not likely that we'll see many of those. It's kind of unusual situation. I think a situation where Vantage was the company that the Total Energies did the deal with. Obviously, it was something that worked out well for them in terms of needing the cash influx. I think probably wouldn't see too many of those. You'd have to have both a drilling contractor motivated to sell off its unit and an operator that has a large number of projects lined up for an extended period of time. So, with Total Energies, they've got work in Namibia and other parts of West Africa that rig could be suited for. So probably wouldn't see too many of those that will have to meet certain criteria to make sense for other companies.
We do have a couple of other questions, but I'm conscious we're coming out of time now. So what I'd like to say is that the questions that we haven't been able to answer in this time, we will reach out directly to those individuals after this call and answer those questions directly. So we're not ignoring you, but I'd like to thank Matthew and Sophie for taking the time presenting. Hopefully everybody's found a lot of some great information there. And more importantly, I'd like to thank everybody who has taken the time to attend this conference and this webinar. Hopefully you've got some information through. As mentioned at the beginning, the recording will be loaded onto the Esgian website, and I will forward a link to that recording before the end of this week. So again, I'd just like to thank everybody else for taking the time, and look forward to speaking to you all in the second webinar series in the middle of 2024. Thanks, everybody. That concludes today's presentation.
Thank you very much, everyone.